Welcome back, and we're in conversation with Mr. Sunil D'Souza, Managing Director and CEO at Tata Consumer Products. Very strong set of numbers. Just to kind of give you a perspective, the India emerging business, which is the new businesses of Tata Consumer, have grown at a breathtaking 47%, and now they're over a third of the India business. So emerging is really coming out and supporting the overall numbers. Sunil, great having you. Let's start off with that actually. This kind of growth, this 47% YOY kind of growth, just give us a sense as to how sustainable that kind of a number is, or whether this is like a one-off in terms of performance.
Before I answer that, I'd like to just dial back. Tata Consumer Products was supposed to move from a tea and salt company into a total food and beverage and then a FMCG company. So what you're seeing today is in line with the plan. And we had said we'll grow organically and inorganically. And the growth businesses are a mixture of that. Whether it is Sampann, which we grew organically, or Soulful, Capital Foods, Organic India, all of which was inorganic pieces. We've always guided for the growth businesses contributing to at least 30% of India growing at 30%. Once in a while, you will hit it out of the park. And probably this is one of those quarters. Today, the growth businesses account for 36% of the India business and have grown at 47%. The good part is all the growth businesses have fired, right? One of the things, Sampann grew at 58, the Ready-to-Drink grew at 41, Capital Foods 40, Organic India 27, Soulful 25. So all growth businesses come to the party. The good part is not only that, gross margins are healthy. Sampann, just to rewind 5 years, 6 years back when we started, it was a -5. Today, it is a +15. Capital Foods, Organic India are significantly accretive to the total business. Yes, overall, we remain bullish about the 30% plus contribution. Today, growth businesses, at least for the last quarter, are higher than tea and salt. Ultimately, they will continue to climb faster because tea and salt inherently will grow to high single digits. And this will continue with the 30% growth.
My understanding, Sunil, excuse me, and you can correct me if I'm wrong, was that the growth for FY27 on emerging was expected to be 30%. This hitting it out of the park with 47, one-off quarter, as you call it. Do you believe that that kind of gives you the confidence to up the kind of growth guidance on emerging alone?
So let me put it this way. Internal targets operate on a different sphere. Externally, we would like to condition for a 30% growth. And the good part is it's when you say growth businesses, we've taken certain categories as targets, right? We've taken premium water, dry fruits, noodles, and cold press oils. Overall, these businesses are growing 90% versus last year. These are our big focuses. And these focuses have been shaped with looking at the category margin, competition, growth rate, and trust deficit, right? And that's creating magic. We spawned new channels in the last 24 months or so, whether it is vending, food service, or pharma. And those are on a 300 crore per year run rate as well. So Tata Consumer Products is a growth company, growth-oriented. Yes, we are lower on EBITDA margins. And the guidance is we will grow EBITDA margins by 50 to 70 bips every year. This quarter, we've delivered 70%, and we remain focused on that.
Right. And with regard to how is, just if you can give us a sense, how is volume evolving on the growth businesses side of things? I'm not sure that you've put this number out, but if you can give us a sense just to kind of understand that off the lower base that some of these businesses operate out of, are volumes extremely strong? And is that kind of volume clip likely to sustain? How is channel mix really evolving out there? If you can give us a perspective on that.
So first of all, overall in the business, we delivered a 13% UVG. I think 13% UVG by any comparison is a decent number. A lot of it was driven by growth businesses. This is not pricing-driven growth. All the growth businesses have grown 30% plus, right? Ready-to-Drink, for example, I think was a 35 volume and a 41 value. Similar story for Capital Foods, Organic India. So it is broad-based volume-driven growth. See, price-driven growth, you can take it up to an extent, but you can't deliver 30, 40% top-line growth just basis price. It has to be fundamentally distribution, marketing, innovation, and volume-driven growth.
Absolutely. And Sunil, that's what's really impressive about the performance this time. And some bit of tailwind, of course, from growth businesses on the margin number, but you've not tweaked pricing, and despite that, you achieved this kind of margin. Give us some perspective on when do those price recalibrations start to happen, and what would the impact of that on margins be? And then very likely the 50 to 70 bips annual will get beaten, right? I mean, in terms of your own guidance.
So number one, we remain. It's a fine balance between volume and value, right? There is a little bit of inflation creeping in, and we've been taking calibrated moves. Tea is showing. We had expected tea broadly to be benign this year, but it's showing about a 7 to 10% price hike. We've taken small bets last quarter. We will continue to take small bets because for tea and salt, we remain laser focused on maintaining between a 34 to 36 gross margin, because that is the sweet spot where we've seen volume continues to chug along, market share continues to chug along. Salt, we've taken a 2 rupees per bag increase last quarter. We moved the bag price from 30 to 32 when we saw Indonesian coal and the rupee dollar changing. Going forward, we will continue to balance volume value. Like I said, we will remain focused on making sure we operate within a certain band on gross margin and delivering top line growth. Overall for the year, if inflation was not to spike up, and this is a big if, because I mean, you never know, it changes by the day. Yeah, we should be able to beat our guidance of 50 to 70 bips increase. Most importantly, because it's not only the portfolio moving, there is premiumization happening within the portfolio. For example, dry fruits, we moved to salted. In salt, 13% growth in value added. So that is happening. And as we grow larger and keep the middle of the P&L tight, we will get scale leverage as well. Last year, we delivered 220 bips of scale leverage. This year also will deliver scale leverage, but when you look at the P&L by alone, there is a lot of moving parts in it, a lot of noise, including forex, hedges, all that kind of stuff. But if you strip that out, we will deliver scale leverage.
And Sunil, if you can give us some color on when the price recalibrations start to play out for you, how are you tactfully trying to pass that through to the consumer?
So on salt, we took it early June. So the consumer would start seeing it now. It starts coming into the P&L middle of June onwards. So that will happen. Tea, small pieces tweaked. You could expect more pieces being tweaked as we go forward. I would say I wouldn't give it a timeline because we remain. So, for example, oil went from 70 to 100, and then now it is down to 92. And when the ceasefire happened, it came down to the 60-70 mark, right? So I wouldn't try to get ahead of myself by trying to forecast this thing. We're just mindful that we're not taking prices for a one-off event, and the inflation is here to stay for some time, right? So that is a wait and watch game.
And what was a knock, if you can give us a perspective of tea on your cumulative, on your blended, on your total margins? What would that knock be? Because the inflation was strong from what I understand.
No, for last quarter, there was no knock. No, last quarter, actually, when I compare it to the same quarter last year, we had tea prices which were lower. And that's the reason why you saw 2% volume, but a 4% value decline. But the margins remained in the 34 to 36 band. We gave back pricing as we saw it. Now we're seeing the reverse trend, and we will go up. But overall, just to give you a perspective of last quarter, impact of overall I would say, define it as the West Asia led inflation was about 60 bips. So if there was no inflation broadly, my 13.6% EBITDA margin would be north of 14.
You know, the other thing that's driving that margin number crucially is branded versus unbranded. The performance of branded has been very solid, Sunil. How do you see over the medium term this evolve, this branded versus unbranded mix? Just India business, if you can give us a perspective first off.
So the unbranded business will not grow as fast as India branded. If I look at it, we've got three parts of the portfolio. We've got India branded, which is core and growth. Then we've got international, and we've got unbranded, right? But the India growth will grow the fastest. India core will grow faster than the others. Overall, international and unbranded, the role is more to make sure they're margin accretive. The drag this quarter was as coffee prices came down. We had to give off pricing. But remember, again, we are more or less a pass-through out there, and therefore margins were not as impacted. The revenues will keep going up and down in line with coffee prices. The good part is we play both sides of the coffee, right? Our US business is on the consumer side, and there you'll see margins expanding as coffee prices now go down. Whereas the solubles business is a pass-through business, and the revenue will come down or go up in line with coffee prices. But overall, it's the India base business which is the which powering the growth, led by the growth category.
And packaging costs, some of the other raw material costs, right? Not directly associated with the product itself, but packaging and the like has also crept up for you. How should one look at the cost levers there, and how much do you pass through? How quickly? What was the margin impact? Could you give us some color on that as well?
Yeah, so like I mentioned, last quarter, there was a 60 bips impact of all-in inflation. Primarily, I would say it's freight, fuel, and packaging. Primarily packaging. That's the big element. Where it has started to impact, we started to pass this through. When I mentioned that we will take calibrated price increases, it is not only for tea cost, it is for overall inflation also. Fuel and freight would be a relatively smaller portion. I would say 80% of the inflation would be packaging. And in food and beverage, packaging plays a larger part. So we will look at calibrated price increases. As I said, the guiding principle is we play within a certain gross margin band, but keeping in mind the competitive scenario as well so that we don't lose market share.
And channel behavior, talk to us about that. That's the other lever where you push volumes out. What really stood out this quarter? What can you do better as the year goes by?
So I would dare say we are one of the fastest movers when it going with the channel shifts per se. For us, trade grew low single digits. Modern trade was up by 20%, and overall, my e-com business was up 51%. Now, e-com, there is a move from everything moving from e-com to quick com. So e-com plus quick com grew by 51%. Overall, I would say we are seeing a shift of the consumer. Indian consumer is becoming omni-channel. So on a particular day, they might be shopping at quick com. When they have time, go down to the kirana, and on the weekends, probably go down to modern trade also. So modern trade, e-com, quick com will grow faster than GT, and that's what we're focused on. Just to give you a perspective, the percentage of online, which is e-com plus quick com, has moved from 15.4 to about 21%, 20.7 or so. And I would expect it to continue to creep up, because if you look at a benchmark market like China, it is significantly above where we are. So as quick com and e-com becomes prevalent, consumer will move there. We are well poised because we are one of the first movers. And as the channels grow, we will get leverage on our spends in those channels.
Sunil, just the last piece, if all these years were about building, FY27 seems to be a year where you're starting to see execution play out and very meaningfully on the numbers. Q1, if it's anything to go by, it's a fabulous start. Would you say that FY27 is that inflection year where you start to really pick up where some of the engines are concerned?
So I would say every year is a landmark year. We've been delivering, if I'm not mistaken, for the last 3 years, we've delivered a 13% top line, 13% EBITDA. EBITDA could have been better, and net profit is roughly about 25. So Tata Consumer is focused on top line growth and delivering EBITDA margin expansion. Last quarter was a good quarter. We brought down even working capital by 4 days. We've upped our ROC by 150 bips. We've delivered 70 bips of margin expansion and top line growth, and the growth businesses have started to fire.
All right. Okay. Sunil, thank you so much for coming in and speaking to us.
My pleasure. Thank you.